Hello, and this is going to be an update for the Ftse, and also I'll be doing a bit of macro. So when I did my last quarterly update, we were around here, and it really did look like we were falling over. Since then, we have to face it, we've actually been in a bull run ever since October. We're up 14% since October, and there seems to be quite a lot of optimism around that we could even be in this crazy all hail new Keynesian economics mode. Now, of course, the FTSE 100 is a rubbish index because it's overweight commodities and it has things like banking stocks and consumer staples faced off against each other, making it a bit of an insensitive index. So I like to use the FTSE 250 as a better guide for what's really going on. But even here, we have the neck break rally of about 18%, and we've definitely broken out of this channel that we were in. Now, of course, last year we had the inflation crisis. This was the Bank of England predictions of what inflation was supposed to do, versus here you can see I've plotted what it's actually done. And so the Bank of England started raising interest rates to combat that inflation. And this explains this controlled demolition we saw. But of course, the narrative the last few weeks is that inflation isn't as bad as it was. Actually, inflation is still quite bad in the UK, but certainly it seems to be going away in the US. Regardless of how we seem to be copying what's going on in the US, the general narrative is that as inflation reduces, people are expecting the Bank of England to stop raising interest rates, and then this is the explanation for this mad rally we've been having. So in this video, I'm going to be going through the macro data to try and work out which of these scenarios seems most likely. So first, it's good to take a step back, all the way back to 1985, and here we see how the FTSE 100's done over time. We've got the dot-com bubble, the credit crisis, and then the corona crash. But what's quite clear is this linear trend up. And that makes sense because generally you tend to get 2% GDP growth every year. Plus, there's also the effect of inflation. So it does make sense for stocks to be going up like this. And when you look just at that, an all hail NKE scenario looks quite sensible, at least just when you just look at this graph. Now, of course, the governments and central banks changed how they managed the economy ever since the credit crisis, when they started using low interest rates and quantitative easing to help keep the markets pumped up. So here you can see the credit crisis, and they dropped interest rates to practically nothing and started printing loads of money. And they only done that even more recently when we had the COVID crisis. This was, however, quite effective in elevating the stock markets and GDP. So here I summarise the new Keynesian economics model that the governments and central banks have been using. They like to change interest rates, and they've had extremely low interest rates recently, and also quantitative easing, which is basically just money printing, as well as various socialist government spending projects. And these are the tools that the central banks and governments are using to meet their objectives of 2% inflation, 2% GDP growth, and low unemployment. Now, one caveat is you can only get away with all the money printing and low interest rates as long as your currency has integrity. And currently, with a government debt of 100% GDP and fiscal deficit of 7% of GDP per year, the markets do kind of consider the pound sterling to be a solvent currency. So our government can get away with these things without everything going bonkers in a way that other governments, say Turkey or Zimbabwe or whoever, aren't able to do that. All down to having this relatively sound currency. Now, the other thing, though, which enabled this spectacular zero interest rates and money printing ever since the financial crisis was we've been in a few decades where we've had these deflationary forces, mainly the growth of the internet, globalization, and technology. So these deflationary forces allowed us to have the low interest rate policy and do all the money printing, because the inflation caused by that was counteracted by these deflationary forces. Now, of course, what's happened is we're in a bit of a energy crisis at the moment because there's just not enough hydrocarbons to enable the progress of society. When you combine the West plus also these new incumbent countries like China and India, Africa and Africa and Brazil, there's just not enough hydrocarbon available for everyone to power forward their civilization. So that has caused a bit of a energy crisis. But then on top of that, when COVID happened, there was a load of extra money printing, and at the same time, because of the government policies, the globalization aspect was taken away. So this changed the whole balance, and then that led to inflation. However, when we look at the US, and here I've got quarterly CPI increases, we see that inflation has gone away. Maybe it was transitionary after all. And so it's expected that the Bank of England won't be raising interest rates so hard because of inflation being on retreat. And that seems to be the main narrative as to why we're pumping at the moment. So now I'm going to go through the data though, and to try and test out, how credible is that hypothesis? So interest rates, we know they're not going to be raising that much. But the big problem in the UK is that we still do have inflation. In fact, we have stagflation because we've still got really high inflation. I mean, it's 11% in terms of year on year, but even if you go by CPI, it's still relatively high. And at the same time, unlike America, where there's fairly good growth, our GDP numbers are really low. And so actually, when you look at real GDP, and that's where I've looked at the GDP numbers month on month, but then deducted what the inflation is. In terms of real GDP, we are in decline, and at the same time, we do have relatively high inflation. So the UK is definitely in what I'd call mild stagflation at the moment. So in contrast to the US, where we have quite good GDP growth and inflation's gone away, in the UK, I'm afraid, we are in a stagflationary period. And add to that, house prices look like they may have topped, but the one bright spot being unemployment is still low. But I noticed that Portfolio Matters pointed out in their last video that unemployment is a lagging indicator. So the data points to stagflation, and here's also retail sales, which also looks stagflationary because the value is start the value stays elevated, but the volume is dropping. So people are paying the same amount for less stuff because it's more expensive. So when I look at UK inflation numbers, the worst inflation, when I look to say at the latest monthly amount, is in food and drink, housing costs, furniture and household goods, and restaurant and hotels. So unlike America, where all the inflation is just more is mainly in the energy area, in the UK we do have quite persistent across the board inflation when I look at these numbers. So it just doesn't make sense to me that the government will be able to pivot hard the same way that the US might be able to, because we do still have inflation as a bit of a problem. And so I don't really understand why we're having this hard rally. I mean, presumably the market thinks that our inflation is going to keep on dropping, the same as it has dropped in the US almost to nothing. And then there will be some hard pivots by the Bank of England. But I think that the energy crisis is there waiting in the wings. I think we have the globalization aspects back, perhaps in a weaker way though. But I think the energy crisis still remains because once India, Brazil, and China are all running on full cylinders, and also Joe Biden is going to have to start restocking the strategic petroleum reserve, how I just can't see how a rebound in GDP won't then lead to a massive spike in oil price again. And I have a pet theory that we're stuck in this stagflationary vicious circle where the world has a energy crisis caused by the decisions of our politicians. And this means that every time we have economic growth, the high oil, commodity, and food prices will kick in, leading to inflation. Then we'll have to have tightening, which will lead to a stagflationary situation, which could then lead to lower energy prices. And then the governments jump in with more QE and IR again. But then this just then completes the cycle. And I can't see us breaking out this stagflationary vicious circle for a number of years, maybe a decade, when either we build enough nuclear power stations or there's some kind of currency collapse, kind of resetting everything. So that's just my little pet theory that I'm working on. In terms of my deliberations, it really wouldn't surprise me to see a massive pump up and even some pivots going on and stuff. But I think the more likely scenario is a choppy sideways. I think that as long as we are in a mild stagflation situation, I can't see us rip roaring higher like we have in the past without energy and commodity prices coming in to send inflation soaring. And as long as that keeps happening, the government can't revert back to its normal NKE policies. So based on my data, I have no confidence at all to start buying in stocks. I'm sure I'll be wrong, of course, but I'm just going to factor in more a choppy sideways kind of thing. We also have to remember that sound currency is also a important requirement for the current economics to work. And the pound sterling, it had a 40% drop at the time of the credit crisis. Then a 20. This is against Swiss franc. Then a 20% drop after Brexit, and then a 17% drop just recently. So the pound sterling isn't in great shape. It has actually, as you can see, it has actually stabilised a bit. This dip here was the quasi-quartan moment, but it has actually stabilised a bit. But when we look at yield curves, like many other countries, we have a flat yield curve, almost looking in danger of becoming inverted. So, although I don't think it's still that high probability, we do have to remember as well that there is a nascent risk of a currency crisis as well, which could then cause a big drawdown. But I'm definitely erring towards more choppy sideways as my main assumptions. I should point out that the Bank of Japan have been in the news lately because this is what a normal yield curve is supposed to look like. But what's been happening is the Japanese, they artificially keep their yield curve in shape by buying loads of government bonds. There was a big hoo-ha recently because they they loosened their policy from buying to keep it at 0.25% at 10 year to below 0.5% at 10 year. When they did that, that caused a lot of drama in the markets. But their chairman went out and said last week that they were definitely going to maintain support going forward. But the problem is that, well, look, the UK's government debt is currently 100% of GDP. The problem is that because the Japanese have been doing this, their debt is 300% of GDP, one of the highest in the world amongst advanced nations. And apparently, according to this article in the Financial Times, they've actually been spending 6% of their GDP every month just to keep the yield curve in control. So you do see that there are nascent risks here of a currency crisis because should that go off the rails over in Japan, that will then definitely have a real bad effect on the stock markets across the world, it's assumed. So there is like some serious nascent risks. Maybe they're lower probability, but there are definitely some serious nascent currency crisis risks. I still just can't believe this all hell NKE model, and so I'm going more with a choppy sideways. Even if we were in choppy sideways, this is the first pump up. I still can't work out which are the best sectors to invest in, and I worry about each cycle. In this kind of stagflationary cycle, it might only last a year, say, between each peak and trough. So I'm kind of scared to go into anything because I like always long-term investments, and so the things I've been looking at, like pharma and commodities, are at real highs, multi-year highs. So I just cannot work out what to invest in at the moment. And so I've got a current target stance of about 30% risk, and that is roughly in line with what my current portfolio is. So to summarize, the fact is we are in a bull run since October last year, but we have mild stagflation with high inflation and dropping real GDP. The data points to an era of mild stagflation. The all-hail NKE scenario cannot be ruled out, and we could see central bank pivots and stonks going up loads. But I think there's a risk that any GDP growth could ricochet. We may hit oil price or inflation ceilings. There's also a nascent risk of currency collapse. I've got a pet theory that we're in a new Keynesian economics moderated stagflationary cycle, which will only be broken by a currency collapse or by solving the energy crisis. And it's going to take 10 years to build those nuclear reactors. But I've never been more uncertain regarding the various likelihoods. So I'm maintaining a defensive portfolio with a target of only 30% risk. So I hope you enjoyed this video. Please remember I do these videos just for fun, and you must make sure you speak to a financial advisor before taking any financial advice. Whatever you're doing, have a good time, and speak to you again soon. Please read the disclaimer and remember that prices can go down as well as up.